Barry, does anything today change anything meaningfully? And what does it mean that we found some resistance at the 50-day?
Yeah, when you think about it, the trade policy that we've been seeing is erratic, bordering on impish. It's hard to put a multiple on that, and so it pays for the street to be a little bit reserved. We haven't really seen a change in the economic data. We expect third quarter to be weak, S&P earnings to be down on a year-over-year basis, nominal growth of about 4, dropping last quarter 4, dropping to about 3.3, and real growth under 2. So it's going to be a soft third quarter. The question is, if that's the bottom, how soon do we get interested in a more cyclical bias? But the S&P looks to us about fairly valued around 2,900 or 26,000 Dow.
And Jeffrey, your view on that same question?
Carl, you called it an eventful day. There have been a lot of eventful days lately. If you look back to when Trump initially announced these tariffs 2 weeks ago, the S&P 500 has only recovered, even with today's gains, half of that loss back. And that's the same thing's true around the world if you look at where Japanese stocks or European stocks. So it's a very difficult market to place big bets, given that a trade, a tweet, any kind of headline can really swing the market quite dramatically. The background is one still of broad economic slowdown, and that doesn't change.
Yeah, Barry, I mean, has fundamentally anything changed? It looks to me like the Trump administration is negotiating with itself. I mean, it threatens to put these tariffs on, and then it says it's going to delay them. There's nothing really solid from the Chinese side here. So what's an investor to do? Aren't you just betting on what signal the Trump administration is going to send next?
Yeah, it's partly trade. I mean, I understand the negotiating strategy of keeping the other side off balance. It's particularly effective against totalitarian regimes abroad that are inflexible, even brittle to recession. So they're off balance. But the other thing to consider is the futures are still pricing in 60 basis points of Fed easing in the rest of this year. And I don't know. I doubt that's going to happen. So when they make the adjustment to that, we possibly have the 10-year yield back up. And if that happens, the economy would be seen as slowing down on the rate-sensitive, yield-sensitive side. So, again, I agree with my compatriot there that there's a lot of uncertainty, and it argues for this range-bound market to continue.
Yeah, Jeffrey, to that point about the Fed easing, I mean, the market really seems to have priced in this surety that we're going to see some sort of cut come September, but you had that CPI reading today, and I realize that's not the Fed's preferred measure. But nonetheless, you had this reading on inflation today. You got the fact that you've got this pushback on some of these tariffs, 10% tariffs on some of the imported goods from China. Does that change the course for the Fed potentially next month?
For all those things you just mentioned, it does. If the Fed's still looking at these moves as insurance measures against weaker inflation or a broader downturn related to trade policy, well, there's less reason for them to take those actions. If instead the economic data continues to be on the weaker side, then maybe this is more than just insurance rate cuts. Maybe this is really the start of an easing cycle, in which case they're still in the game. I think the stock market thinks these are insurance cuts. The bond market seems to be viewing these as the part of a longer-term easing cycle and the cusp of another global recession in 2020.
Hey, Barry, we had John earlier in the year, and you were, I would say, had a contrarian point of view that the market was overestimating earnings for the year, that the Fed was too tight. And now that that thesis has come your way, I just wonder what you make now, and specifically of the curve inversion, and whether we're paying too much attention, getting sort of fixated on that too much.
Yeah, I agree with the previous statement that the bond and the stock market have come to disagree here. I actually would put a little more stock in the stock market. I think that third quarter will be weak. I think people will be surprised. I mean, we're at -5 on S&P defined operating earnings in the third quarter. The street is about 0 or +1 on growth year over year. So disappointing earnings, disappointing real and nominal GDP. That could put in your typical third quarter seasonal low, sell in May, go away, come back after Labor Day. And then sometime towards September, October, we might get a takeoff. But I question the strength of that takeoff because we are so dependent on cheap rates, cheap money, low yields, that it limits any backup potential. Plus, we're just talking about inflation bottoming and not really taking off here.
So, Jeffrey, if you look around the globe, if you look at all the geopolitical risks that are out there, some of the other currency dynamics that are happening, Argentina, for example, just yesterday, the economic growth outlook for other regions of the world, is the U.S. still the best house on the block, or would you be putting your money into other markets right now?
That's a great question. I think the globe is very tightly synced up here. And I think if we are on the cusp of a next great recession, then I think all markets are headed lower, including the U.S. But I would say this. Europe might offer a little bit of shelter from the trade storm. I'd point out a couple of things. One, they're not directly affected by the U.S.-China trade tariffs, whether they're on or off. But there are a number of other factors that I think could lead to stimulus. Germany, about tomorrow, to get their second quarter GDP number could be slightly negative. That suggests fiscal stimulus from Germany in the form of tax cuts or other things that they have the budget to do. And that could spread throughout the Eurozone, something not priced into markets right now, and very low valuations there. So there could be maybe some upside surprises here as markets begin to take a look at other ways economies could face some stimulus in the coming year, not just from the Fed or central banks.